What if we told you that just avoiding these 12 mistakes could dramatically boost your investment returns? You see it time and time again, people jumping into the stock market thinking they found a golden ticket to overnight wealth. But the reality is, building lasting wealth takes time, patience, and discipline. It's about avoiding costly mistakes that can set you back years. The world's most successful investors, people like Lynch, Warren Buffett, and others, didn't get where they are by accident. They learned to avoid the pitfalls that trip up so many other investors. In this video, we're going to look at 12 mistakes that you must avoid to put you at an advantage over almost all other investors. We'll show you how to think like the pros and make smarter decisions with your money. If you find this video helpful, make sure to subscribe to our channel for more tips on smart investing. Mistake number 1, failing to stick to a plan. Let's be real, having a solid investment plan is like having a roadmap to your financial destination. Without one, you're just driving around aimlessly, hoping you'll magically stumble upon success. And trust me, that rarely ends well. That's why it's crucial to first define your goals. Are you saving for retirement, a down payment on a house, or your kid's college fund? Once you know where you're headed, you can chart a course and choose the right investments to get you there. But it's not enough to just have a plan, you gotta stick to it. I know it can be tempting to deviate when the market gets volatile, but that's actually the worst time to abandon ship. Remember, investing is a marathon, not a sprint. There will be ups and downs along the way, but if you've done your research and built a diversified portfolio, you'll be in a much better position to weather any storm. Stay focused on your long-term goals, and don't let short-term market fluctuations derail your progress. One of the biggest benefits of having a plan is that it helps you avoid making emotional decisions. When you invest based on your gut feeling or the latest hot stock tip, you're essentially gambling with your hard-earned money. So do your research, create a plan that aligns with your goals, and stick to it. Mistake number 2, trying to time the market. Let's talk about one of the biggest mistakes investors make, trying to time the market. They think they can predict when the market will go up or down, and they try to buy low and sell high. Sounds easy, right? But here's the thing, it's impossible to consistently time the market. Even the most seasoned professionals with all the fancy algorithms and data analysis tools can't do it consistently. The market is influenced by countless factors, many of them unpredictable economic data, geopolitical events, even the weather can impact stock prices. It's like trying to predict which way a leaf will fall from a tree. It's completely random. Think about it. If you could predict the market with any level of certainty, wouldn't you be a billionaire by now? The truth is, trying to time the market is a fool's errand. Instead of trying to predict the unpredictable, focus on what you can control, your investment strategy. Invest consistently over time, diversify your portfolio, and don't panic when the market inevitably takes a dip. By investing consistently and staying the course, you give your investments the opportunity to grow and compound over time, regardless of short-term market fluctuations. Mistake number 3, letting fear and greed control you. Fear and greed, they're the two emotions that can completely derail your investment journey. They're powerful forces that can cloud your judgment and lead you to make irrational decisions. Let's be honest, investing can be an emotional roller coaster. When the market is soaring, it's easy to get caught up in the euphoria and start thinking you're invincible. You see your portfolio growing, and you want to chase those returns, often taking on more risk than you can handle. This is greed at play. But then, the market takes an inevitable dip, and fear sets in. You see your gains evaporating, and you start to panic. You might even be tempted to sell everything, locking in your losses and missing out on potential future gains. The key is to recognize when these emotions are influencing your decisions and take a step back. Don't let fear or greed cloud your judgment. Remember why you invested in the first place, your financial goals. Instead of making impulsive decisions based on your emotions, stick to your plan. Investing is a long-term game, and it requires patience, discipline, and a level head. Mistake number 4, having unrealistic expectations. Let's talk about those get-rich-quick schemes you see all over the internet. You know, the ones that promise to turn a few $100s into a fortune overnight. They prey on people's desire for quick and easy money, but the reality is those schemes rarely pan out. In fact, they often lead to substantial losses for anyone naive enough to buy into them. The truth is, building wealth takes time and patience. It requires a long-term perspective and a willingness to ride out market fluctuations. When it comes to investing, it's crucial to have realistic expectations. Understand that while the stock market has historically trended upwards over the long term, there will be periods of volatility and even downturns. By making smart investment decisions and staying the course, you'll be amazed at how your wealth can grow over time. Mistake number 5, lacking patience. In the world of investing, patience isn't just a virtue, it's a necessity. Too many people approach investing with a short-term mindset, looking for quick wins and immediate gratification. They chase the latest hot stocks, jump in and out of investments, and constantly tweak their portfolios in search of that elusive edge. But the truth is, this kind of impatience can be detrimental to your long-term success. The stock market is not a casino. It's not about trying to outsmart the system or get lucky with your picks. It's about participating in the growth of companies and the overall economy over the long haul. Think of it like planting a tree. You wouldn't dig it up every few weeks to see if the roots were growing, right? You'd give it time, water, and care, knowing that with patience, it would eventually flourish. Investing is the same way. You need to give your investments time to grow. Mistake number 6, failing to do your own research. Look, I get it. Researching investments can seem daunting, especially if you're new to the game. It's much easier to just follow the crowd, listen to the so-called experts, or chase the latest hot stock tip. But here's the thing. Blindly following the herd can be a recipe for disaster. Remember, those experts you see on TV? They're often incentivized to promote certain stocks or investments. Their interests don't always align with yours. And those hot stock tips? They often come from people who are more interested in pumping up the price of a stock so they can sell it for a profit. That's why it's crucial to do your own research. Take the time to understand the companies you're investing in. Look at their financials, their management team, their competitive landscape. The more you understand about your investments, the better equipped you'll be to make informed decisions. Remember, knowledge is power. Mistake number 7, having a short-term mentality. Here's a hard truth. The get-rich-quick mentality has no place in sound investing. Trying to make a quick buck in the market is more akin to gambling than investing. Successful investing is about building wealth gradually over time, not chasing short-term gains. It's about understanding that true wealth is built through patience, discipline, and a long-term perspective. By focusing on the long game, you allow your investments to compound over time, generating significant wealth in the process. Mistake number 8, focusing on getting rich quickly. Look, we all want to get rich quickly. It's a natural human desire. But the reality is, trying to get rich quick is one of the surest ways to lose your money in the market. Those flashy headlines promising unrealistic returns, they're designed to prey on your emotions and lure you into making impulsive decisions. Don't fall for it. Real wealth is built brick by brick, not overnight. Instead of chasing those get-rich-quick schemes, focus on investing in solid companies with strong fundamentals and a proven track record of growth. Mistake number 9, making emotional investment decisions. We've all been there, that moment when you see a stock skyrocketing and you feel that urge to jump in, FOMO gripping you tight. Or on the flip side, the market takes a dive and you're tempted to sell everything before it all disappears. These are classic examples of your emotions hijacking your investment decisions. Before you make any investment decision, take a step back and ask yourself, am I making this decision based on logic and research, or am I being driven by fear or greed? Remember, your emotions can be your worst enemy when it comes to investing. Mistake number 10, acting on speculation. The internet is awash with rumors, speculation, and so-called insider information about the next hot stock. But remember, just because you read something online doesn't make it true. In fact, much of what you see is misinformation designed to manipulate stock prices. Don't get caught up in the hype. Before you invest in any company, do your own research. Don't base your investment decisions on rumors or speculation. Mistake number 11, following the herd. Investing can feel like a popularity contest. Everyone's chasing the latest hot stocks, following the crowd, and trying to get in on the action. But here's the thing, when everyone's doing the same thing, it's often a recipe for disaster. Remember the dot-com bubble? Everyone was piling into internet stocks, driving prices to unsustainable levels. And then the bubble burst, and countless investors lost their shirts. The lesson here is simple. Don't blindly follow the crowd. Do your own research, think independently, and don't be afraid to go against the grain. Mistake number 12, lacking investment discipline. Investing isn't about trying to get rich quick or outsmart the market. It's about setting financial goals, creating a plan to achieve them, and sticking to that plan through thick and thin. This requires discipline. It means tuning out the noise, ignoring the hype, and staying focused on your long-term objectives. The market will test your discipline, but those who can maintain their discipline, who can stay the course even when things get tough, are the ones who ultimately succeed. Discipline means sticking to your investment strategy even when it's tempting to deviate. Peter Lynch once said, "The key to making money in stocks is not to get scared out of them." Remember, investing is a long game. There will be ups and downs along the way, but by avoiding these common mistakes and staying disciplined, you significantly increase your chances of achieving your financial goals. If you enjoyed this video, we bet you'll enjoy the 2 videos now appearing on the screen. Go ahead and click on one of them now. We'll see you in the next video.